Hi, this is Brian Vendig, President and Chief Investment Officer here at MJP Wealth Advisors. As we start to come to the close of 2025, I thought this would be a great opportunity to check in with all of you and give you our views for what lies ahead for year 2026. So with all that being said, I'm going to jump right into it for today. And the first thing I want to highlight are some of the major 2026 market risks that are out there. And we characterize those into three categories: policy risk, productivity risk, and the risk of the 10-year treasury going over 4.5%. So on the policy risk side, I think that's something that we really understand and we've already experienced this past year. Anything new coming out from Washington, the Federal Reserve, how things might percolate through the global economy on a new, trade agreement or measure that might be out there from a geopolitical point of view, has caused the market. It's caused volatility in the market and has given time where investors have taken pause. We don't see this risk going away for 2026. I think that's evident by the things that are up for debate right now with our friends in Washington, whether it's on healthcare or government spending and budgets in the future. There's another budget debate coming up at the end of January of next year. We also know that tariffs are something that's always percolating. Things sitting right now with the Supreme Court and how that might change the way tariffs are implemented for next year. And of course, we know that there's going to be a new Fed chair next year, and that might influence the path of interest rate cuts and monetary policy there. So these are all things that we're going to pay attention to. And so it's easy for me to forecast that there's probably going to be pullbacks in the market next year based on policy risk. But the one thing that we've seen from investors over the course of this year is that the knee-jerk reaction seems to dissipate as time goes on. So if there is a pullback in the market, I think it makes more sense now moving forward to assess that information, see how logical it is to be implemented or what the implications are of that policy measure. And then from there, make the correct decisions or have the correct reactions moving forward. So I think a little patience as new policy comes out for next year. That's something that we're going to do on an ongoing monitoring perspective. But I just want to highlight that to all of you because I know sometimes when these things come out of different policy setting groups, it creates a little bit of anxiety and emotional reaction for all of you. The next category is productivity risk. And I think this is a risk when you think about the amount of spending that's happening with AI innovation. Is that spending going to continue next year? Is that going to lead to gains in productivity for the U.S. workforce and companies, which could improve bottom line results as well as providing more goods and services on a more efficient basis? That's something that I think a lot of folks are watching. We're watching as well. We do believe in the AI innovation trend. We don't think it's a bust over time. We think it's a boom. But we probably will see some of this spending shift next year from 26 into 27, maybe some projects being delayed because it seems like people are coming a little bit more to their senses to make sure that there's a return on capital as it relates to the amount of spending that's occurring. But we don't think this trend's going to stop. But if we don't see those productivity measures, if we don't see things improving to support the labor market, then I think there is a risk to the market. And I also think there's a risk to the economy, which would then increase the probability of a recession over time. However, for 2026, we're not expecting a recession for next year. And I think at the end of the day, we're looking at some of the measures that are out there for forecasts for next year that would actually say the contrary. Now, the last point I'll just make regarding risk to the market for next year is the 10-year treasury. We've seen a resistance point on the 10-year, meaning if the interest rates go up past 4.5% on a 10-year treasury note, that usually ends up spelling bad news for the stock market and the bond market. And I think the only thing that would drive yields up that high over 4.5% and keep it there consistently is if we have inflation percolating well outside of expectations, the U.S. economy growing well outside of expectations, and also if there seems to be any loss of confidence from foreign investors buying U.S. debt. Those are all risks and things that we should be aware of, but ones that I don't necessarily say are material for next year, but it's definitely something that we're paying attention to. Now, on the flip side, when we look at things from an opportunities perspective, we recognize that market valuations are higher than historical norms. But when we look across the spectrum of U.S. equities, we see opportunities in value stocks, mid-cap stocks, small-cap stocks, and we also see a very robust earnings forecast for next year. When we think about earnings for next year and how that kind of affects the overall different parts of the market, the first thing is companies are expecting to grow earnings by about 13 to 14% next year. And that kind of factors into how economists are viewing the recession probability, for next year, which right now is currently pretty low. We also have a labor market that we know is bending, not breaking, due to, I think, a confluence of tariffs still being in the picture, business leaders holding back on hiring until they get better predictability of prices for goods and services, and supply chain, and which all impact profits. But we are collecting more than in additional tariff revenue, which helps us support government spending in the short term. And at the same point in time, we do have a restricted immigration policy, which is also causing, for some sectors of the economy, reduced hirings. So we expect this trend around the labor market to continue. The Federal Reserve has said the same recently in December. So a labor market that's bending, not breaking. And the Federal Reserve has also indicated next year that they are expecting unemployment to stay roughly flat while the U.S. economy is growing, because they are factoring in some of those productivity gains that I was mentioning earlier. But at the end of the day, when we take a look at what drives a market, it's earnings. And the earnings that has come in so far for quarter three, which just ended recently, those earnings results actually were double what analysts were expecting. And that's something that we saw back in the second quarter. In the third quarter, those results also eclipsed analyst estimates by significantly, as I mentioned. So when we look at 2024, we're looking out at 2026. The expectations for earnings growth is around 13 to 14%. And it's actually contributions of earnings coming from areas outside of mega cap tech. So a broadening of the market, which is why having some exposure to growth in technology is in your portfolios, and that will maintain. But we're also been adding to exposures to dividend stocks, value stocks, mid and small, and international over the course of this year to get ready for next year, because we're expecting a slight rotation in the market and growth coming from areas outside of mega cap tech, which is a healthy sign, I think, for the overall stock market. Now, when we take a look at where some other measures that are out there, looking at things from policy that's been passed, with the tax bill that was passed on July 4th, we're expecting about 150 billion more year over year in tax refunds to consumers. The U.S. economy is expected to grow next year, but I don't think it's going to grow as much as we saw this year. Historically, in the second year of a presidential cycle, the U.S. economy has grown by about 3%. I think we're expecting growth next year between 2%, but less than 3%. Definitely first half of the year, starting off pretty well, but then as the year goes on in 26, slower economic growth, because as much as the consumer might be stimulated by some additional tax refunds, I think consumers are sensitive to price. We know that whole affordability conversation quite well, a disproportionate wealth gap that does exist in the country. And so as a result, I think as time goes on, prices will reset relative to consumer demands. We don't see inflation on a runaway path, especially based on data that has recently come out with recent job reports, inflation reports, and consumer spending reports. But we do see the economy sitting in a good place, because the tax reforms not only have helped consumers, but it's also helping businesses, because businesses are getting additional tax deductions for making commitments to research and development, capital expenditures, infrastructure investments, and those are all things that help to support the cyclical part of the economy. The other thing I also want to mention is that we're still biased more to US equities, even though we have increased our international equities in your portfolios. And that's because the US economy still has the best return on equity as compared to any other part of the world. And we've also seen that since Liberation Day, foreign investors have come back into the US markets, buying bonds, buying equities. And so I think there was a concern earlier this year about the confidence in the US moving forward. I'm not saying that we're not running deficits, and I'm not saying we don't have problems to tend to, but I do think that as interest rates change around the world, there might be a little bit less demand for US Treasuries, but we definitely don't see that falling off a cliff. And we definitely continue to see the reinvestment of capital coming into the US just because we command a higher return than other comparable examples around the world. And the last thing I'll just mention is when we think about the next year ahead, if you have questions about your personal financial plan or your portfolio, definitely please feel free to reach out to a member of our advisory team. But I think in summary, what we're trying to say is some of the risks are identifiable or known, and we're calling them out and raising those to your attention. But I think on the flip side, there's a lot of good news items that are still out there regarding economic growth of the country and of the economy, low risk of recession, profit growth from companies, and also an opportunity for other parts of the equity market to participate next year that might not have been participating as much in 25. And lastly, we are continuing to maintain a very conservative, high quality, short duration bond exposure to minimize volatility from equities. And we don't believe that's going to materially adjust anytime soon as we watch for more inflation numbers, more interest rate numbers, and getting a better sense of what the Fed's going to do in 2026 after we hear who our next Fed chair will be. So I hope that's a great summary for today, but I appreciate all your time. Hope you and your families have a wonderful holidays and you have a chance to relax and reflect, and wishing you all a happy, healthy, and prosperous 2026. Thank you very much for the opportunity to work with you, your family, your businesses. We truly appreciate it and look forward to talking to you again in the new year. Thanks so much.